Are there new ideas you can use to increase the returns in your portfolio? Well, quite possibly. Tonight, I'm going to introduce you to convertible bonds. Very possibly a way for you to increase returns and capture some upside gains. So make sure you stay tuned for this edition of the Master of Money.
This Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individuals. This Master of Money was produced Tuesday, June 2nd, 2015.
Welcome back, my friends, to this edition of the Master of Money, the show that is all about helping you build a better path down that journey to prosperity. Well, I'm Steve Beeman, your host, and it's my pleasure each and every week to bring you the insights you need in the economic and financial world and sift through the garbage to show you where the rubber meets the road. On tonight's program, I'm going to be talking to you about convertible bonds. This is quite possibly a very neat way for you to increase your returns and get a little bit of jump in your capital gains. This is something that I learned about many, many decades ago. Well, there I go aging myself again. But I learned about them from a guy who's a real practitioner in these things. I'll share that story with you in the second half of the program. But I'm very excited to present you with the information you need on convertible bonds. Now, looking at last week's program, I talked to you about hedge funds. I spoke to you about three different characteristics of these things. Number one, I talked to you about the structural difference in hedge funds and how they differ from a normal investment advisor. I talked about how they can take a performance fee, and that gives a slightly different incentive to the hedge fund manager than the fiduciary position of an investment advisor. The second thing I spoke about is how the structure of these partnerships allows hedge funds to use leverage way beyond what you and I can use, and I gave you a couple of examples of how that leverage is a double-edged sword. Third and finally, I gave you some very specific investment ideas that you can pick on, different themes that the hedge funds use, and I showed you some of our favorite exchange-traded funds and how those can come to play in your portfolio to help you get some of those hedge fund-like returns. Now, as always, if you have questions on that program or any other program, please feel free to write me at questions@safefinancial.org. We are there to serve and support you, and we do that best when you reach out to us. Now, also, as you go to the Safe Financial Network, you can view all of the archives of the Master of Money, as well as our Safe Insights that are up there. They're available to you at no charge. Remember, the Society is a not-for-profit organization, and if you like what you see on the Master of Money, please click on that little donate button and help support the Society to the extent you're able. Now, looking into the viewer mail last week, we really do have the smartest viewers on television, if that's what this is. Let's call it in stream world. But one of the viewers wrote me and said, last week we talked about Greece and how they were experiencing some really big problems. Well, this week he asked, what will be the next countries to fall? Is this a domino effect? Let's remember that 2008's meltdown was originally started by a little division of a company in Europe. That snowballed, one thing led to another, and before you knew it, the U.S. economy and the global economy was at risk. So the concern from this viewer is, will this happen with Greece? Well, right now, Greece is certainly the worst of the European Union, but you've got some other countries that are in a little bit of trouble. Coming off the 2008 situation, Ireland was in big trouble back then. They've come back, but they're still in a relatively precarious position. So is Italy, and so is Spain. When we look at these three nations, will they domino right after Greece? I don't think so. But is there a possibility for it? You betcha. And that's why, for the Masters of Money, we stay conscious of what's going on around the world because it does come home to hit your bank book. This is highly relevant to you. And so as you look out at Europe, and let's watch Greece closely in the next months, we're going to find out if that's an isolated incident or if it's going to fall down through these other countries of Italy, Ireland, and Spain. I think Portugal could go into that list as well. Now, as we move into the geopolitical and economic world, number one on the list is clearly still Greece. Greece is a country that has 130% of its economy in debt. Both long-term debt and short-term debt are serious problems for the Grecian government. And right now, coming up in June, July, and August, they've got major payments due to the International Monetary Fund as well as the European Central Bank. The question is, what will they do if they can't make those interest payments? Now, the reality is the central banks have stepped up and supported Greece regularly because they're trying to avoid this problem. But this time around, there may be no bailout for Greece, and that means the Grecian economy could literally collapse. We'll stay tuned to the Master of Money as we sift through the news on this and try to bring you the most insightful commentary on it possible. Secondly, in the geopolitical side, OPEC and all of its tin pot dictators are going to meet this week to talk about cutting production by about 1.5 billion barrels a day in oil. Now, their hope is, of course, this will offset the growth in the United States delivery of oil and get prices back up from this $56 barrel range, maybe to 70 or 80. Well, I don't think that's going to happen. The number one player in OPEC, Saudi Arabia, came out and said, "Niet, no, not going to happen." Saudi Arabia wants to keep production levels just where they are, and just because Venezuela is on the verge of severe poverty because of that socialist regime's policies, I don't think Saudi Arabia is going to hold a tear to them. I think they'll keep production about where it is. And let's remember that even if OPEC does that, in today's world, the United States has the capacity to use fracking to generate more than enough domestic oil consumption. So I don't think that's going to end up being big news at all. And finally, in the geopolitical area, well, the Chinese are on the radar today, and some of you may have read about this. China is actually recapturing land in the South China Sea. This is international water, and they're building islands, literal islands, by dumping tons and tons of sand on top of reefs. They're using those islands for military installations. Well, it's gotten pretty hot so far. The United States has had some of its very advanced spy planes fly over there, and there's radar commentary from the Chinese military saying, "Get out of our space." Well, this isn't their space. This is international space. And it's yet to be seen how the United States and the globe will respond to this. Certainly, the people in that part of the world, be it Vietnam or the Philippines or Hong Kong or Taiwan, are not real happy about this. The United States to date has taken a pretty hard line and said they won't let this stand. But are we going to go to war with China over this? I highly doubt it. So we'll have to see what these installations do and how the United States and especially our global partners around the world react to China taking a very aggressive stance on adding land to their already enormous continent. Now, moving into the economic side, just last week, former Fed Chairman Ben Bernanke was in Hong Kong, and he absolutely lambasted the U.S. Congress. Now, there's a lot of reasons you and I could criticize Congress, but Mr. Bernanke's commentary was centered on their favoring the Asian Infrastructure Investment Bank, you and I've spoken about that, over the International Monetary Fund. The IMF is the West's equivalent to the Asian Bank, and he was saying that Congress is giving favored treatment to the AIIB over the IMF, giving, therefore, more control to the Chinese out of the Western influence of the IMF. Well, I've got a couple of points to make on that. First, the fact that you even know about the Asian Infrastructure Investment Bank, you're on the top level of most people's knowledge around the world. When you go to a cocktail party sometime, mention the Asian Infrastructure Investment Bank and its impact on the IMF, and everybody will think you're a guru. Well, the reality of it is this. As the world changes geopolitically, the West, Europe, the United States seems to be in a more flat growth rate, where the Far East, led by China, is in a very aggressive growth rate. The Asian Infrastructure Bank will cut into the Western influence on banking around the world. Will it be a bad thing? Well, we don't know. It's going to be a thing regardless. We'll have to determine down the road whether it's a bad thing, but certainly Mr. Bernanke was upset about it. The second thing in the economic side is his successor, Janet Yellen, was in front of Congress. And she was relaying to Congress that the Fed will, and I think her quote was, "will be very patient when it comes to interest rates? Well, if you watched the markets last week, you saw some gyrations midweek, and that was caused by a concern that as the Fed raises rates, the long-term rates are going to skyrocket. Well, Ms. Yellen's commentary shows the Fed is very concerned about this. The economic growth in the United States has not been strong enough to necessarily support a growth in interest rates. But holding a zero interest rate policy is hurting savers. Those of you who are trying to accumulate money, you know what I'm talking about. When you get paid 0 to 1% on your money, it doesn't exactly incent savings. So what we're doing is incenting people to spend, but they're not spending like the Fed would hope. Well, that's going to result in them really being cautious on these interest rates. They don't want to act too fast or they'll kill the economy, but they have to act at some point. And that leads to my third topic idea in the economic world. Last month, American savers bumped up their savings rate to about 5.6%. Now, what that means, if you translate it, picture the economy as a whole. People are saving 5% of their income. That's not bad. As long as we keep it above 5, that's a pretty robust number. And obviously, in an economy where we're not rewarding saving, we're rewarding consumption, it's nice to see the American consumer outthinking the government and actually saving their money. This bump up to 5.6% shows both a pay down of debt as well as putting a little rainy day fund aside. And I'm very glad to see it as one who has spoken around this country on the dismal American savings rates. So I was glad to see that. And again, as people save money, it can be a slowdown effect on the economy near term, but it leaves a capital base for the long term. So we want to see a good savings rate. Well, as we move into the markets, last week, as I said, was a little bit tumultuous, but net, we stayed within this very narrow trading range that we've been in. All three of the major indexes, the Dow, the S&P, and the NASDAQ, ended up within 1% or so of where they started the week, all three above their historic record levels. That's all good. By the way, I want to digress for a minute because I did have a viewer question who asked why I use those indexes. Now, again, I grew up on Wall Street and in financial services, so these things are second nature to me. But I know for a lot of you, something as simple as an index may be kind of complicated. Well, here's why I use those three. Pardon me. The Dow, or the Dow Jones Industrial Average, is an index of 30 stocks. They happen to be just about the biggest stocks in America, so I look at the Dow as a bellwether for how the big multinational companies are doing. That's a 30 stock, very limited index, but it gives you a good indication of how the world is doing. The S&P 500, well, that's a little broader. It's got 500 stocks, so you come down a little bit in size, and it's a better indication of how the American economy is doing. And the NASDAQ, well, that covers a whole lot of stocks, and it's an indication of how smaller companies are doing. So you get three very real looks at the world when you look at the Dow, the S&P, and the NASDAQ. There are lots of other indexes, and I could include those as well. But I think by using just these three, you get a pretty good handle on what the market is doing as a whole. Now, finally, as I leave you this first segment, I want to bring to you an article I read in USA Today. And I found it very interesting because they gave their 5 big things to look for when you're considering or contemplating retirement. Well, I want to go through those 5 with you. I know that many of our masters of money are either thinking about retirement or maybe even in retirement. Well, these 5 keys apply to you equally as well, no matter which group you're in. The number one thing on the list, don't call Social Security in too quick. Here's a common mistake people make. If you are 62 years old, you're able to get your Social Security payments. But if you wait and you hold off till you're 70, the amount of money you can get on your Social Security check is several times what you could have gotten at 62. So contemplate delaying your retirement perhaps until 70. Now, the reality is, all of you know this, we're getting younger in a way. I'm 53. I'm much more equivalent to my parents' generation at 43. For me to work till 70, well, that's not a big deal. I'll still be very healthy and very productive. So as you think about retirement, consider the incentive from Social Security to stay in the workforce. The second thing they brought up, and I really like this because I thought it played well to what we preach all the time, and that is have a budget, have a plan, and hire a professional. Now, we've talked time and time again, folks like me spend our lives doing this. Theoretically, we know a little more than you do. Now, I want to do all I can to bring you up to speed so that we can talk, but when it comes to hiring a professional, they may have some ideas for you on how to build a better plan, how to execute a better plan. And when you talk about like tonight's topic of convertible bonds, well, they'll have a pretty good sense whether those fit within your parameters or not. Now, the third thing they mentioned, and they actually highlighted this, it could be considered a part of that second, but the third thing they said, do not, repeat, do not under any circumstance retire without a plan. How common is it for individuals to retire at 67, 70 years old without a plan, and much to their surprise, by 75, their income has dropped to the point of unsustainability? Don't put yourself in that position. Planning for retirement is everything. You have to learn how to use your capital in a way that it will last your lifetime plus some. So those three right now, have a plan, hold Social Security, and get a professional. The number 4 thing on the list is it's never too late to start saving. The fact of the matter is, whether you're 40, 50, 60, or 70, saving capital is how you become wealthy. So don't shoot yourself short by saying, oh, I'm 55, it's too late to start. No, it's not. Start putting little bits aside now. If you have nothing put away, start small. Save the pennies and the dollar bills that you have in your change. Build that up to a nest egg of $1,000 or more, and then start to invest it and let it grow. It's never a bad idea to save money. Never forget that. And for grandparents out there who might be watching The Master of Money, beat that into your grandkids so when they're 20, they start saving money and become part of the capitalist economy. The final thing that USA Today said was, don't be afraid of the stock market. Man, oh man, how many times I've talked to people, I don't play the market, I don't get invested in that. The U.S. stock market is the measure of the U.S. economy. As our economy grows, so does the stock market. It is one tool you can use to make your money grow. Yes, you can put it in treasury bills from the government, loan them your money. Very, very safe, but very low interest. You can loan it to a bank in the form of a certificate of deposit. Again, lower interest, very secure. You can loan a company your money. So you go right to corporate debt. Higher interest yet, but still pretty secure. Or you can go in smartly to the stock market and ride the capital gains of those companies that grow. Well, the fact of the matter is that's a way to make money and preserve capital, so you don't want to be afraid of the stock market, but you don't want to go into it without the knowledge of a master of money. So stay around through the break. We're going to be right back. And when we come back, I'm going to introduce you to something I really like. It's called a convertible bond. It can give you kind of the best of both worlds. So stay tuned, and we'll be right back for this edition of The Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too. But we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the Master of Money as we enter the second half of the show, dedicated to teaching you everything you need to know to build that better path to prosperity. I wanted to mention as we enter this, for those of you who are just joining us, you may not be aware that the Society offers an audio library by the name of The Path to Prosperity. This is a 12 CD set that actually takes you from soup to nuts through financial literacy. So if you're just beginning, click on that little button on the site called Donate Here, and for donations of $100 or more, the Society will send you a Path to Prosperity audio library. Would you like to know how banks really work, how insurance works, how you get out of debt, how you get income security? Well, check out the Path to Prosperity. Well, on tonight's program, I mentioned to you that I'm going to start it with a quick story. Back when I started and co-founded Chicago Investment Analytics with two extraordinarily bright guys, I'd like you to meet them someday. Well, I ran into a prospective client here in the Chicago area. The firm was Calamos Investment Management, and this was a little investment advisor out in the western suburbs in a small little building, but they were doing something rather unique. They'd set the focus of their investment firm on convertible bonds. Well, roll the clock forward 30 years, and guess what? John Calamos, the founder of Calamos Investments, is now a billionaire, and Calamos Investments no longer sits in a small little building in the western suburbs. They have several buildings in the western suburbs, and they have built one of the most successful investment advisories in the country off of convertible bonds. Well, what's so unique about these things? Why do they really hit the attractive part of a person's portfolio? At the core, a convertible bond is this. Let's say you're CEO of a company and you want to go raise money. You want to build a new plant, you want to expand some way, so you need to raise money. Well, you call up your Goldman Sachs investment banker, hey, Mr. Investment Banker, I need to raise money. And they sit down with you and they say this, well, to raise money, you can either sell debt, in other words, you can borrow the money from a bank or from individuals, but because your company maybe isn't that big or you're not that credit worthy, your interest rate would be pretty high. Well, the other option is to sell equity. But as you come through the program, you'll learn that as you issue equity, you dilute your stock, so it can cause your stock price to drop. So as chairman of the company, you say, well, I don't want to pay that high an interest rate. I don't want to lose that much equity. What can I do? Well, sitting right in the middle is a convertible bond. It's a debt instrument that will pay a lower interest rate than most debt instruments because attached to it is the ability to convert it into the common stock of the company, sometimes the preferreds, but normally the common stock. And let me give you the math. This isn't very complicated, but whenever I go to math, I get worried that it's overly complicated. So I'm going to try to keep the example real simple. Let's assume this company that you're the chairman of has a current stock price of $30. And you talk to your investment banker, and he says for you to borrow money on a 10-year basis, you're going to end up paying 7.5% interest. So you look at 7.5% and say, well, that's going to be tight on my cash. He says, well, if you issue stock, that's going to dilute the value of your stock from $30 down to $25. Well, that's not good. As chairman, your job is to see the stock price go up, not down. So as you come to this agreement on the convertible bond, you agree that let's offer a 10-year bond for 3% interest, about half, and let's allow it to be convertible into the common stock at, say, $32 a share. That way, you don't get diluted unless the stock's moving up and you're paying a low interest rate. So who wins in this transaction? Well, clearly the company does, because they're able now to get the money they need to expand their operations. The investors win because they get an interest rate that's better than cash, but not quite as high as a pure bond, but a nice solid interest rate, and a conversion into common stock to give them some capital gain if things go well. Now, for the investor, another dimension is simply that they have higher priority if the company has real problems on liquidation. Remember, bondholders get priority over stockholders, so it's a nice position to be in. So everybody wins. And the investment banker, well, they win because they take a commission selling it. So it's a win-win all the way around. So the question then is, why doesn't everybody do this? Well, more often than not, companies don't really want to issue these because they don't like things that convert into their common stock. They don't want to offer stock if they don't have to. They just assume you had a pure debt offering, and that's what they try to do. So we have a situation where if a company has to, they'll issue one of these, but they don't often want to. The other interesting thing about convertibles is every now and then, you'll find one for sale where the exercise price of the conversion, our example was 32, is lower than the stock price. So let's assume in this particular situation, you have a bond that has a conversion at 32, but the stock ran up to 35. Well, there's something called an arbitrage, and I'll talk about that more in a minute, but an arbitrage allows you to sell in one market simultaneously buying in the other. Well, if you can convert at 32 and then sell it in the market at 35, you'll buy those bonds all day long. And that's exactly what a convertible arbitrage fund does. They look for convertible bonds that are trading below their conversion prices in the market. Gives a great way to generate some returns. Now, we've gone through kind of the how and why. So the companies do this clearly to grow and expand. And as American enterprises go around the globe, they have a real need for cash and for growth. This is a very elegant way to do it. And as I said, everybody wins in this. It's a negotiated thing, but everybody wins. Now, again, let me talk about some more reasons why these aren't great, because I never want to leave you with the thought that, gee, this is the best thing in the world. I'll just do this all day. Let me touch on some reasons why these aren't the panacea of investing that, gee, just go home. Number one, companies that offer convertible bonds oftentimes are more risky than other companies. They can't afford to pay the higher interest rate, so they agree to swap it for their stock. Well, that gets into typical valuation and other measures of the quality of a company, so you want to make sure that the company whose bonds you're buying are strong and stable. Number two, the only value in this thing really is if the stock runs up above where your conversion price is. In our example, if you buy that and it converts at 32, but the stock never goes there, well, you paid a lower interest rate for no upside. So you want to make sure that the companies for which these are offered have good valuations, good growth rates, and even good momentum, so they're likely to grow through that break point so you can make some capital gain. Third thing I'd like to make you aware of is that it's very rare for these things to trade below their conversion price. If you can find one, that's wonderful, but they typically don't. So it's not an end-all be-all solution for you, but it can be a very strong solution. Now, I like to give you some ideas on how they might fit in your plan, so I'm going to give you 5 exchange-traded funds that you might find interesting to look into. Number one is iShares Preferred ETF. Year to date, it's about a 2.9% return. Not all bad, but it's certainly, if you didn't have the upside kicker to it, that's not the kind of return that would excite you. But with the upside kicker, you're looking at a 4, 5, 6% return for the year. Secondly is the Barclays Capital Convertible Bond. This has generated about a 5.7 return for the year. And again, up on the screen, you see this. You have preferred portfolio, financial preferred portfolio, and Wells Fargo preferred stock portfolios. These are all exchange-traded funds that give you liquidity, they give you control over your money as well as tax advantage. So talk to your professional. If you think convertible bonds fit in your portfolio, well, that might be an awfully nice way to play it. But as always, if you have questions about this, I urge you to write me at questions@safefinancial.org. Never forget that the Society is there for you. We are your friend in financial services. Now there you have it. Those are convertible bonds, and they're certainly not the end-all be-all to investing. But to get a little higher return, to get a little juice to your portfolio, a good convertible bond situation might serve you really, really well. Well, I appreciate your joining me tonight as we've journeyed on this trip. And I look forward next week to seeing you once again for an all-new edition of The Master of Money. But until then, Have a happy, healthy, and prosperous week ahead.